You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. You are listening to Watching the Financial Survival Network. I'm Kerry Lutz. It is 1/26/22. We're on with our good friend Rick Rule, who has been on a permanent regulation vacation. His right to commercial free speech has been restored, and we're all grateful for that. And Rick, happy 22. It's great to have you back on. So I figured, well, number of topics I want to cover with you, but maybe the first one is crisis on the horizon. And do you see a crisis? Are we approaching it? Is it Fed induced, or is it just cyclical in nature? Is there anything that can stop it if in fact it's on its way?
I hate to use the word crisis because I don't like to be hyperbolic, but I think we're coming into a circumstance that will be difficult for many people to deal with, and perhaps difficult for people to comprehend. A circumstance where, as an example, interest rates have to rise because there's a negative real rate of return on savings. So you're punished for saving, which means you're punished for capital formation, and capital formation is necessary for growth. So the fact that interest rates have to rise and interest rates can't rise appears to me to be an interesting conundrum. A different conundrum is that society has underinvested in the means of production around natural resources and basic materials for 3 decades and continues to underinvest. And the underinvestment is really exacerbated by the Green Revolution. At the same time, the global population is growing. And the poorest 1/3 of humanity, at least materially, aspires to the same standard of living that you and I have, which means that demand for raw materials increases at the same time that as a consequence of underinvestment, the supply of raw materials decreases. The collision between, in what are, in many senses, the correct aspects of the Green Revolution, with the expectation of rising living standards for a broad population, is another conundrum that I think will generate circumstances which are going to be very tough for society and for individuals to deal with. I'm not, Kerry, one of these people who says, the end of the world is coming on Thursday, and here's how you can profit. That isn't what I'm about. Other generations have had challenges. I think about the generation before me. They had little things like the Great Depression and World War II. So I'm still, in the long term, an incurable optimist. In the United States, as an example, we have a society where 5 or 6 kids can commandeer a garage in Sunnyvale, and out pops Google. And the good news is that the next location of that garage is very likely to be Yangon or Lagos or La Paz. In other words, as the world becomes better educated and better connected, it is likely that the next Silicon Valley will occur in a place that we don't expect it to come from. And that's all wonderful. Getting from here to there, Kerry, I think is going to be interesting, and perhaps interesting in the context of the Chinese curse. May you live in interesting times.
Yeah, well, it reminds me getting in a taxi in New York and asking to go someplace, and the guy telling me you can't get there from here. And, it always is impossible, yet somehow we figure out a way.
Yeah, Kerry, we're gonna. It's just unfortunately going to be pretty interesting. If we slowed the rate of government growth and we, for a while, lessened the burden of regulation on a global basis, if we restored some semblance of globalism, we could grow our way out of our malaise. Notice, however, that I preface that with the word if. Kerry, if we were scripting a word, a scripting world, pardon me, the Politburo in Congress would be massing to fight each other on the border of Russia and the Ukraine, and we wouldn't have a war. There are solutions to all these problems. It's just that these solutions are unimaginable at present, but we'll find a way through. The idea of this broadcast is to help your listeners find a way individually to shield themselves from what are otherwise collective problems.
Yeah, well, I always say where there's a will, there's a lawyer, right? So about that. So recently, gold, silver's performance, the most interesting thing I've seen on multiple days is gold going up, silver going down, or vice versa. What, from your experience, can we glean from that? Because that's rather unusual.
I think in the short and intermediate term, markets are all noise and no music. I have learned myself that measuring my net worth, however tempting it might be on a daily basis or a quarterly basis, is ludicrous. Money is made or lost over 3 years or 4 years or 5 years. So the first thing is, with the intermediate noise, don't listen to it. There's no information there. Many people think of markets as a source of knowledge. They're not. They're mediums of exchange. They're places that you buy and sell physical assets. So don't confuse a market with what it isn't. It isn't a source of information. It's a source of confusion. If you desire confusion, then of course, pay attention to every tick in a price. Kerry, we've talked about this before, but behavioral finance teaches you, first of all, that people have recency bias. What happened to them in their immediate past shapes their view of the future more than history does, where history exerts more influence. And narrative is driven by price, which is to say, oddly, if you believe in gold as an asset class and the price goes down, making the asset class cheaper, the fact that it went down makes you question your faith in the narrative, where if the price goes up, which makes it arithmetically less attractive, the fact that the price went up justifies the narrative in your mind. What I've learned through two past epic bull markets, the 1970 to 1981 bull market and the 2000 to 2011 bull market, is that although the warning signs that the circumstances are becoming less favorable for conventional savings and investment products and therefore more favorable for gold are in evidence, society, investors don't pick them up for 2 or 3 years. You'll remember, and some of your listeners will too, in the decade of the 60s, we began to have really ugly price inflation in the United States at the same time that we had price-controlled interest rates, which is to say there was negative real interest rates in a rising price environment. But the realization of that, the gradual realization of that, didn't take place into the popular consciousness all the way from sort of 1967 to 1973, and didn't get underway in earnest until the second half of that bull market in 1976. So when your listeners say, this is true, this is true, this is true, and this is true, and this is the result, they're correct. The result is probably inevitable. The problem is that they confuse the word inevitable with imminent. It doesn't mean that because all those things are true, that the result is going to happen very, very quickly.
And you make a great point. Inflation commencing in the 60s, the Johnson administration's Great New Society and a guns and butter, meaning you can have a war and everything can be normal. And as a result, we had major inflation, less understated perhaps than the inflation is today in the statistics, the government statistics that are released. But Rick, like what you said about history and recency bias, very few people who are alive today were cognizant of the inflationary boom, if you will, during the 60s and 70s. They weren't alive or they were really young. So this kind of lesson's got to be relearned here.
Mercifully, for those listeners who care, there's lots of documentary evidence around that. The periods of the 50s and 60s in particular were fairly benign periods. The post-war economic boom, the incredible benefits that we saw from the increasing globalization of the 1950s, the productivity boom in the United States. Wonderful, truly wonderful times. And times that Congress sought to continue so that they could, as you point out, finance both the war on poverty, which of course they lost, and the war in Vietnam, which of course they lost. The outcome of that, particularly the wage and price controls instituted by President Nixon, set up the circumstance of the 1970s, what I would describe as the reckoning of the 1970s. And I think, unfortunately, that we have to endure another period of interesting times as a consequence of the benign economic climate that we as a society have enjoyed for the last 40 years. The period of 1982 to 2022 probably goes down as the longest period in human history, at least human history that I'm aware of, that we've enjoyed things like this. Violent wars have been on the decline. The living standards of the bottom third of humanity in the last 30 years have enjoyed remarkable strides. It's really been a lovely time. The interest rate on the U.S. 10-year Treasury fell from 15.5 or 15.6 to 1.5. What could be better than lower cost of capital, plentiful trade, the ability for those who cared to develop the skill sets to give them utility, to be able to sell that utility for higher prices over time? All good. And while not all over, we no longer have the tonic of falling interest rates because negative real interest rates are a construct of Congress. They're not a force of nature, and that's going to come to an end.
Agreed. And perhaps there might be a lot of pain involved with it, but capitalism, free markets don't work when you have real negative interest rates, because it changes everybody's calculus. And like you said earlier, penalizes savings. So based on what you're saying, underinvestment in resources, basically, with the exception of perhaps oil and energy. But aside from that, really, when you look at exploration budgets now and by every metric, underinvestment's been prevalent. What do you think the 5 most important factors with why you should basically own or be thinking about resource stocks in 2022 and beyond?
Well, it's impolite to contradict my host, but I'm going to. There has been extraordinary underinvestment in oil. I would estimate roughly that the deferred sustaining capital and new project investment in the oil and gas business exceeds $1 billion a day, meaning that the major oil companies, state-owned and privately owned, are deferring well in excess of $300 billion in capital a year, which means that the ability to produce is falling at the same time that demand for the product is rising. Unlike other sectors of the economy, the cost of capital in the oil and gas business is going up, not down. As the equities become lower priced relative to value and relative to cash flow, it means that the equity cost of capital is going up. At the same time that the sort of political winds, the green political winds, are constraining the industry's access to pension capital and debt capital. So we have a situation here where, despite the fact that demand for oil and gas is rising, and I suspect will continue to rise for 20 years, Ms. Thornburg notwithstanding, major oil producers around the world, OPEC as an example, never mind raising quotas, they're having trouble producing their existing quotas. So I would suggest to you that despite the fact that the oil industry is horrendously profitable at these product price levels, they aren't investing enough to maintain production. They're decapitalizing their businesses, which means that oil prices and gas prices probably stay higher for longer. I have calculated roughly the Oil and Gas Journal index of publicly traded oil and gas companies on a price net present value basis or price EBIT basis is pricing in $45 West Texas Intermediate and $2.75 or $3 per million BTU natural gas, when the selling products for these prices in the case of oil is over 80, in the case of natural gas is over 5, which is to say that oil and gas prices don't have to rise. They can even fall fairly substantially from here. And the equities are, from an economic point of view, cheap. You need to constrain yourself as an investor and only buy those companies that are in fact making the necessary sustaining capital investments to maintain their production and pay dividends. But if you do that, the first place that I'd like to see people in the resource business, including investors for income, is precisely in the oil and gas space.
And it's indispensable. There's been times, when you look back 10, 15 years ago, we had this fracking boom with nat gas, and we had thousands of wells shut in. Now, I can't find any statistics on how many nat gas wells are actually still shut in the United States. It doesn't seem to be a statistic that is published. Can you give us any insight in that? Are there?
I can find it, but right now demand for natural gas is exploding, and anybody who has a well that's capable of producing is producing it. What's happening in the shale business with regards to gas is that these wells are fairly capital intensive, and the cost of drilling and completing these wells, when your cost of capital goes up, you're drilling less wells than you would expect given the product prices that we face today. The second thing is that these wells decline very, very rapidly. Conventional oil and gas wells may have a life of 15 or 20 years, and they may have a half-life, that is the period of time over which they produce half of their economic reserves. That's 5 to 7 years. The half-life of an unconventional well, a frack well, may be a year, and the economic life before retreatment at least may be 5 years. So the circumstance where, first of all, there's a higher cost of capital, which means that there's less drilling activity, at the same time that there's very high depletion and depreciation, means that the production boom that we in the United States and laterally the world enjoyed from these unconventional technologies is unlikely to resume in the same dimension anytime soon.
Interesting concept. It makes total sense. Before you go, like when I was in business, and on occasion you wanted to terminate an employee, but they played a somewhat vital function. Before I would go doing that, I would always look to have a replacement. And anything you need, if you're going to stop using gas, you better have a viable replacement. Otherwise, you're going to be biting off your nose to spite your face. We're not doing that here. We're just saying it's got to be replaced. Stop using it now.
Kerry, you make a wonderful point. When I give interviews like this, in the comments section, people always say, Rick's investing in buggy whips. There's not going to be an oil and gas business. We're all going to be driving electric vehicles. I would ask people to examine what it is they're saying. In the oil and gas business, the effects of deferred sustaining capital investments are quick, not long term. You can impact the industry's ability to produce in 2 years or 3 years with a hiatus in new project investment. And if your audience, except for the 11 that drive Teslas, believe that when they go in the morning up to the garage and turn the key to the right, that the car will start, they believe in at least $60 oil. If those same people looking at the electric revolution go around the world outside developed countries, if they go to most of South America or all of Africa or most of Asia, they will see a distinct lack of electric infrastructure to run electric vehicles. What they are going to see is the bottom third of humanity that wants to graduate from walking to a bicycle, or wants to graduate from a bicycle to a 50cc motorcycle, or wants to graduate from a 50cc motorcycle to a Toyota Hilux. The ascent of living standards of the bottom third of mankind is and will be the primary driver of demand for industrial commodities of all types, but energy in particular. And I would encourage those people who believe that you're talking about the end of conventional energy to ask themselves, in the first instance, should the bottom third of mankind become less poor? And B, is that trend, that beneficial trend, which we've seen over the last 30 years, likely to continue, pardon me. And if you think that that's going to happen, the only logical conclusion is that you are an oil and gas investor.
Yeah, these crises, these shortages, they're really of our own making, because with the failure to realize the truth of what you're saying. And when we look, I mentioned to you earlier that at a get together, leading mining executive says, "Hey, the same people who are pushing the green revolution are the same people who are stopping development of vital resources to make it a reality, i.e., 12 to 20 years to build a copper mine of any scale." And that's a schizophrenic kind of attitude towards the resource market.
Don't just survive, thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project, with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network. The information you need to thrive now more than ever.
Kerry, what you say is so true. And the evidence of that irony is everywhere. President Biden doing whatever he can to kill the oil and gas industry, and now asking them to produce more because there's shortages. That's an irony in one man. And by the way, I'm not picking on the Democrats. The Republicans are equally ironic. The irony in Serbia, which has a very, very, very powerful Green Party, to deny the ability of the Serbs to open an absolutely critical lithium resource, which would, of course, provide components for the very batteries that they're insisting on. The fact that in the United States, we have a wonderful copper deposit called Resolution, which we've now been working on for 20 years, that will probably be another 15 years in permitting before it can provide the copper that's necessary to move power from areas, as an example, that have a lot of wind and no people, to areas where there's a lot of demand for wind-generated electricity and lots of people. The irony around that, well, let's just say it's more than irony. Let's just say it is, in fact, a problem. The world is demanding the same things that the world is prohibiting. Now, in Chile, as an example, which supplies 30% of the world's copper, and has been responsible for the economic growth of the strongest economy in South America, the electorate has decided all of a sudden to increase the social rents around copper mining by 400%. This does a couple things. It kills the goose that laid the golden egg for the Chilean economy, while at the same time, these increased social demands lower the probability that the whole green electric revolution that most of the world wants to see is going to occur. So the circumstances that you described, the irony around these circumstances, while I don't understand how they're going to play out, are things that have to be discussed among the broad society in one instance, but particularly around resource investors on the other.
So copper is going to be in shortage.
Unless we have a recession or a depression, the impact of 30 years of insufficient investment in the copper industry and the increasing cost of social rent and regulation will mean that 5 years from now, we have a supply shortage in copper, almost no matter what we do, absent a recession or a depression that kiboshes demand.
And we're talking an acute shortage. We're not just talking like, a few million tons short. We could be looking at massive shortages.
Well, the lovely thing about that is that markets work, price matters. I don't think that we'd have a shortage at $12 copper, because you would see, as an example, a substitution for aluminum for copper in long distance wires. Markets are really, really, really messy. People hate them, but they work. We wouldn't have a shortage of $150 oil either. People would drive less. That's what would happen. So if the price mechanism works on copper, it will delay certainly the green revolution, the electric revolution, but we will have a market clearing price. We will be able to deal with copper shortages. We'll just deal with them by making copper more expensive.
Yeah, and the price, going back to Austrian classical economics, price is the ultimate allocator of a resource. And when government sticks its nose in the tent, like the camel, that's when the fun begins, because you get malinvestment and you get lack of investment a lot of times because it's just not worth the burden of it. So copper, definitely a reason to be long copper. Let's talk about uranium. It's kind of the same thing as copper, but on steroids.
I'm fascinated, as you know, Kerry, with the uranium market. It's treated me very well for a very, very, very long time. And uranium may be the classic example of something where the price had to go up, did go up, has to go up further, and will go up further. The International Energy Agency on a global basis suggests that the incentive price for new copper production exceeds $60 a pound.
Uranium, yeah.
And in addition, that price is going up very fast because of supply chain inflation, regulation, and permitting woes and social rents. My suspicion is that 3 years from now, the uranium price will need to be $70 a pound. At the same time that the political wind around uranium is increasing, it is increasingly being viewed as an attractive fuel from an environmental point of view. So at the same time that demand for uranium is increasing, and at the same time that society, particularly in Japan, is going to allow the restarts of the uranium business, the uranium market is stalled. It's important to note, too, that as the uranium market stalled, the index of uranium equities represented by the big ETFs is off by 40%. Precisely at the time when the future is more certain, the prices are declining. Later in the show, or at the end of the show, I'd like to talk to your listeners very briefly about a uranium boot camp, a uranium investment boot camp that I'll be putting on. Because I think that the uranium market offers almost uniquely something where the physical price almost has to increase, absent a recession or depression, from $45 a pound to $70 a pound. And the consequence of that is that a well-chosen portfolio of uranium stocks likely doubles, triples, or quadruples from here. When I say well-chosen, there are probably 70 companies that purport to be in the uranium business worldwide, and probably 12 of them are buyable. Buying a uranium penny dreadful doesn't mean that you will participate in what I see as an inevitable updraft. But I certainly think that uranium is the poster child for the ironic collision that you're talking about between the green future and the need for humankind to access more electricity, at the same time that it is perceived wrongly to be a politically incorrect energy source.
And it's so ironic here, talk about ironies of all ironies. There were three events, well, actually four, but three in the 60s and 70s that really set the collision course that we're in now. Number one, 3 Mile Island. Number two was the Ukraine, I can't remember the name of it, of course. Chernobyl, how could I forget that? So Chernobyl. And number three was a movie with Meryl Streep called Silkwood that really painted this industry as the most evil industry on the planet, wanting to poison everybody, and that lives on. And then we had Fukushima, which was kind of the nail in the coffin. But now uranium is an environmentally sensible source of energy. And I never thought I would live to see that, Rick.
I don't think that we're in a situation where we're out of the woods with regards to plant safety. The new plants are much, much, much better engineered and mostly much better constructed than the 40 and 50-year-old plants. But we have a bunch of 40 and 50-year-old legacy plants, and some risks remain. It's important to note, however, that any electrical source that we use carries risks. There's no such thing as a risk-free reward in society. Natural gas explosions are not uncommon. In terms of background radioactivity, there are a couple of fly ash piles in Ohio and Pennsylvania that by themselves emit more background radiation than every nuclear plant in the world combined. The idea that there is some risk-free alternative to increasing living standards for 7.7 billion people on Earth is at best naive.
All right. So that's three. So what's our fourth here? We're looking lithium, or is there another resource?
Well, I think the easiest one for your listeners to wrap their heads around is probably gold and silver. Precious metals do well during periods of time when the purchasing power of fiat savings and investment products is in question. And anybody who isn't questioning the ongoing purchasing power of their savings denominated in fiat in a negative real interest rate environment is a person who isn't really very conversant with arithmetic. So probably the easiest resource for your listener base to wrap their heads around in terms of probabilities, there's no certainties in life, but in terms of probabilities, is gold and silver. The historic resolution of counterfeiting and quantitative easing and negative real interest rates has for millennia been precious metals. When they will resume their upward march is a different question. I don't know when that happens, but it seems to be like a when equation rather than an if equation. I think I can demonstrate with the Goldman Sachs 100-year commodity charts that I've mentioned so often on your show, that there are a whole range of industrial materials. Nickel, lithium has certainly repriced, but I think it probably holds these levels. Coal, which is roundly hated. Most people don't know that the year that saw the greatest demand for coal around the world was 2021.
I know.
After lithium, the best performing commodity of 2021 was thermal coal. The whole range of commodities like that, ammonia, phosphate, potash, these are all commodities that suffer from the same irony that oil and gas and copper do, a historic underinvestment. At the same time that demand for them increases because of increased living standards and population around the world, with an overlay of increased social rents, increased permitting, which is to say supply constraints and unrestrained demand. Goldman Sachs, which is more a fan of the broad economy than my economy, is actually calling for a commodity supercycle. The fact that they think that's going to occur leaves me wondering whether it will in fact occur or not, maybe because of skepticism over the messenger. But I certainly do see a circumstance where we're doing all we can to constrain supply at the same time where demand remains unconstrained. If you believe that markets work, declining supplies and rising demands usually generates rising prices, which is what I suspect will happen this time.
All right. So nickel, another metal that is vital to this green future, at least at the present time, certainly vital battery metal. And again, prices have been low, underinvestment, not a lot of large mines coming on stream. A classic example, it's going to be like pretty much like copper, but again, on steroids.
Kerry, you're right. And more than half of the world's nickel production comes from mining nickel laterites in Philippines, Indonesia, Malaysia, places like that. And this is really environmentally destructive. Those countries are now getting rich enough that their societies are demanding that the environmental destruction that they have faced and are facing, maintaining world nickel supplies change, which means that the cost of producing nickel is going to increase. If you are lucky enough to find a sulfide nickel deposit somewhere in the world that doesn't require this incredible destruction that comes from mining nickel laterites, you have found a very, very, very valuable beast indeed.
Yes, for sure. For sure. Hey, off the beaten path a little bit, but lumber. All right. We saw a huge run up during the pandemic. It's gone down a little bit, but lumber is one of those elements essential all over the world for any type of improvement in housing and social betterment.
Kerry, I'm laughing because my track record trading lumber is virtually unblemished by success. I've never been right. What I can tell you is I've done very well investing in timberland. That is to say, the means of production. If I give myself 5 years to be right, I do a much better job than if I give myself 2 or 3 years to be right. You know that I recently built a house And mercifully for me, my general contractor said, I have a bad feeling about lumber availability. Let's buy a bunch of lumber. For the first time in my life, I caught the lumber market right, but it had nothing to do with me at all. It had to do with that great Wall Street genius, the contractor in Anacortes, Washington, who just had a feeling because he lived in a lumber town that demand was outstripping supply and I better lock in my lumber.
And that is another area where the United States has gone out of its way to diminish production, and prices have just skyrocketed over the decades. And so, right, you actually won at lumber futures with a short future, but you won at it, right?
Accidentally. I take no credit. I take no credit for that, Kerry. If I ever get bullish about random lengths again, short it.
Yeah, okay. Well, we'll try to keep that in mind. So, but I think the final message is you can profit from these trends and you should profit from them, even if that makes you an evil speculator who's preying upon the misery of humanity, right?
You know, Kerry, we actually need to deal with this. I realize that you were being sarcastic.
Totally.
If your listeners believe that the bottom third of mankind deserve access to better living standards, you should invest in making that available to them for your own purposes, to be sure. Most people don't realize that 1.2 billion people on Earth have no access to electricity. Most people don't realize that another 2 billion people on Earth suffer from intermittent or unaffordable access to electricity. Making electricity available to the 85% of Congolese who don't have access to electricity is, at least from the Congolese perspective, a good thing. There are about 1 billion people in the world who don't have access to sufficient affordable nutrition on a daily basis. Making 1,600 or 1,800 affordable calories a day available to those people is, I would suggest, a good thing, not a bad thing. And the irony that increasing the material well-being of mankind, but particularly the poorest third of humanity, the idea that that's a bad thing requires special skill sets. It reminds me of the 450 or 500 private jets that flew to Davos to tell us common people that we're consuming too much carbon.
Yeah, well, life is full of ironies. Well, you gave us about 20 reasons why you need to be in resource stocks, especially in 22 and further, because the problems that you described, Rick, are long-term in the making, and they're long-term for solutions to implement, to hopefully see the market implement the solutions that really the betterment of humanity demands. And that's where policy and government and environmentalism and economics, industry have somehow got to come to a better understanding of the issues and their solutions. The solution is not less. The solution is more. And I think you've really elucidated that point extremely well, Rick. And for that, we're always grateful. Your regulation vacation is reaping untold benefits because now you can say what you really think. And there's always a plus for that. We appreciate it. Rick, your website and your newsletter, everything, how do we connect with you?
Yeah, as an incentive to your listeners to connect with me, I renew my offer to, on a no obligation basis, no cost basis, review your listeners' natural resource holdings. All they have to do is go to a website, ruleinvestmentmedia.com, enter your natural resource stocks. I'll rank them 1 to 10, 1 being best, 10 being worst. I'll comment individually on issues where I think my comments might have value. Please no crypto. Please no technology stocks. Please no pot stocks. Keep in mind who and what I am, an old Luddite. 2, if you want the charts I mentioned, the Barron's Gold Mining Index and the Goldman Sachs commodity charts, in the question and comment section at the website, say charts. If you care about learning more about the uranium market, on March 19th, I'm going to have a 6-hour online uranium investors boot camp. Cost $99. If you don't think you got your $99 worth, contact me after you've attended. I'll give you a refund. We'll have representatives of the 3 biggest uranium companies in the world, Cameco, Kazatomprom, and in particular China General Nuclear, talking about the uranium market outlook from the point of view of the biggest producers in the world. We'll have uranium traders, uranium analysts, all things uranium for 6.5 hours, $99. If you don't think you got your money's worth, I'll make sure you do by giving it back to you. Get information at the website by saying boot camp in the question and comment section, and I'll happily send you that.
All right. I think I have located the link for it. Rick Rule's Uranium Investors Boot Camp, kind of a mouthful. It's March 19th, 11 a.m. to 7:30 p.m. This is like a marathon here, Rick. And I think it's well worth your while to go. That's Eastern time. The link will be in the show notes. And look, if you can't afford the $99, legitimately, just send me an email. I'll front your tuition and you could pay it back at some point in the future. I've actually set up a little nonprofit to enable people to attend events such as Rick's where you can't afford to. And I think this would be a great expenditure of some of those funds. So Rick, appreciate it. Hey, if you got a question for Rick, shoot me an email as well, kl@kerrylutz.com. Rick, always a pleasure, always enlightening. We'll talk to you again real soon.
My pleasure, Kerry. Thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.